Hello, I'm Ali, and in this lesson we'll talk about analytical procedures. As per ASA 520, analytical procedures involve evaluation of financial information by studying plausible relationship among financial and non-financial data. Analytical procedures identify the fluctuations in accounts that are inconsistent with the auditor's expectations based upon their understanding of their client. For example, if an auditor is aware that their client has borrowed a significant amount of money in the previous financial year, a decline in the client's debt to equity ratio would be quite unusual and would lead to further investigation. It is necessary that an auditor has clear expectations about their client's results for the reporting period before conducting analytical procedures, so that unexpected fluctuations can be correctly identified and investigated. Analytical procedures are conducted throughout the audit. However, the purpose is different. During the risk assessment phase, analytical procedures are used to help in the risk identification process. During the risk response phase, analytical procedures are an efficient method of estimating account balances. At the final or reporting stage, analytical procedures are used to assess whether the financial report reflects the auditor's knowledge of their client. In the rest of the recording, I'll be looking at the application of analytical procedures at the risk assessment phase of the audit. Analytical procedures are conducted at the risk assessment phase of the audit to highlight the unusual fluctuations in accounts, aid in the identification of risk, enhance the understanding of a client, identify the accounts at risk of material misstatement, and minimize audit risk by concentrating audit effort where the risk of material misstatement is greatest. ASA 315 specifies that an auditor should perform analytical procedures as part of their risk assessment process. Analytical procedures help identify inconsistencies, unusual transactions or events and amounts, ratios and trends that indicate matters that may have audit implications. Unusual or unexpected relationships identified may assist the auditor in identifying risk of material misstatement, especially risks of material misstatement due to fraud. Analytical procedures include simple comparisons, trend analysis, common size analysis, and ratio analysis. Now, we'll be looking at some of these forms of analysis. Simple comparisons are made between account balances for the current year and the previous year, and the current year and the budget. When comparing account balances from one year to the next, significant changes are tracked and investigated further by the auditor. Auditor assesses these changes in light of their expectations based upon their understanding of the client and any changes experienced over the past year. For example, if a client has opened a new retail outlet, sales may be expected to have increased since last year. When comparing account balances with budget amounts, an auditor is concerned with uncovered variations between actual results and those expected by the client. Significant unexpected variations are discussed with the client personnel. Trend analysis involves a comparison of account balances over time. Trend analysis is conducted firstly by the selection of a base year and then restating all accounts in subsequent years as a percentage of that base. It allows the auditor to gain an appreciation of how various accounts have changed through time. For both simple comparison and trend analysis, it is important for the auditor to consider significant changes in economy-wide factors, such as recession, which may affect their interpretation. This figure provides an example of a trend analysis. In this figure, 2018 is selected as the past year, as the base year. The following year appears as a percentage increase or decrease of the 2018 amount. The following years appears as a percentage increase or decrease of the 2018 amount. As I said, for example, sales in 2019 were 20% lower than sales in 2018. In 2020, sales were only 10% lower than 2018 figure. And in 2021, sales grew to 20% higher than the 2018 amount. A trend analysis helps an auditor to assess movements in the accounts over time and determine whether the underlying trends discovered through this type of analysis match their understanding of the client and its activities over the period under review. The third one is common size analysis, or you can say vertical analysis. This procedure involves a comparison of account balances to a single line item. In a statement of financial position or balance sheet, the line item used is generally total assets. In the income statement, the line item used is general sales or revenue. With common size analysis, the auditor gains a deeper understanding of how much each account contributes to the total presented in the financial report and how this changes over time. So now this figure provides an example of a common size analysis. The line item used in income statement is sales. This figure shows that cost of sales grew in 2019 compared to 2018 and then reduced as a proportion of sales in 2020. There may be several reasons behind these changes, such as change in prices charged by suppliers, prices charged to customers, and or quantity of goods on hand. In the balance sheet, the line item is total assets. You can see inventory level rose in 2019, then dropped, which may indicate a build-up of inventory on hand when sales dropped in 2019. The next ratio, the next is ratio analysis. Ratio analysis is used by an auditor to assess the relationship between various financial report account balances. For this, the auditor calculates profitability, liquidity, and solvency ratios. So now, the first one is profitability ratios. Profitability ratios show a company's ability to generate earnings and ultimately the cash flow required to pay debts, meet other obligations, and fund future expansions. The first profitability ratio is gross profit margin, which is a gross profit divided by net sales. This ratio indicates whether a seller of goods has a sufficient markup on goods sold to pay for other expenses. A markup is the difference between the selling price and cost price for goods sold. A decline in gross profit margin indicates that a client may be paying more for their inventory or charging less to their customers. The next ratio is profit margin, which is equal to profit divided by net sales. This ratio indicates the profitability of a company after taking into account all operating expenses. If profit margin varies widely from year to year, this indicates volatility and uncertainty, which normally makes it difficult for the auditor to assess the truth and fairness of the current reported earnings without further investigation. And if the profit margin is steadily declining, this may affect the future viability of the client. The next two are ROA and ROE. which are very commonly used in companies to monitor and assess their clients, their own performance and the performance of their senior staff members. ROA is equal to profit divided by average assets, and indicate the ability of a company to generate income from its average investment in total assets. ROE is equal to profit divided by average equity, and this indicates the ability of a company to generate income from the funds invested by its ordinary or common shareholders. If both ROA and ROE are falling, it will affect the ability of the company to pay dividends to shareholders and interest and repay loans, which are also dependent on the client's ability to generate cash. So these are the common profitability ratios calculated by an auditor. The auditor will make comparisons between the current year and previous years to identify the trends in their client's profitability. The auditor will also compare these ratios with budgeted results and with competitors. And if significant variance is found, it is discussed with the management and investigated further by the auditor, as variance indicate that there may be a risk of material misstatement. So in the next category, I'll look at liquidity ratio. Liquidity ratios reflect the company's ability to meet its debt obligations. The auditor is concerned with their client's liquidity situation as an indicator of potential going concern issues. There are a number of short-term ratios that can be used by auditors when assessing their client's liquidity situation. The first liquidity ratio is current ratio, which is current assets divided by current liabilities. This ratio indicates how well current assets cover current liabilities. A ratio greater than 1 indicates that a company should be able to meet its short-term commitments when they fall due. However, in practical life, this depends upon the ability of a company to convert its inventory and receivables into cash on a timely basis. The next short-term liquidity ratio is quick ratio or acid test ratio, which is equal to cash plus short-term investments plus net receivables divided by current liabilities. This ratio indicates how well liquid assets cover current liabilities. Acceptable benchmarks for current liabilities and QR vary from one industry to another. The auditor will compare the trend in both ratios over time to assess whether their client situation is improving or deteriorating. The auditor will also compare these ratios with the industry average to assess their client's liquidity relative to close competitors. Inventories turnover, which is equal to cost of sales divided by average inventories, and measures how many times a company sells its inventories in a year. The auditor will look at the trend in this ratio to determine whether inventories are being turned over more or less frequently from year to year. This ratio varies widely from one industry to another. For example, the turnover for a supermarket such as Coles would be expected to be much higher than for a luxury boat manufacturer. An auditor compares the inventories turnover for their client to the industry average to determine whether their client is competitive and has a high as high a turnover as its rivals or competitors. When a client's inventories turnover slows by more than expected, the auditor will spend more time testing for the valuation of the inventory as the stock may need to be written down in response to slowing demand. In this situation, the auditor will also investigate whether sales have fallen in line with the slowing inventories turnover. Receivables turnover, which is net credit sales, average net receivables, and it measures how many times a company collects cash from its debtors. A decline in this ratio may indicate that the client is making sales to customers who are unable to pay for their goods on a timely basis. If this ratio falls, the auditor will spend more time considering the adequacy of the allowance for doubtful debts. The inventories and receivables turnover are used as liquidity ratios, as well as being indicators of managerial efficiency and client activity. In the next category, we will look at solvency ratios. The first one is debt to equity ratio, which indicates the relative proportion of total assets being funded by debt relative to equity. A high debt to equity ratio indicates that a client may not be able to meet interest payments to borrowers when they fall due. Generally, companies with long-term debts are more likely to have a debt covenant with a lender, which restricts the company's activities. The auditor will consider the trend in the client's debt to equity ratio over time, and if there is an increase in the debt to equity ratio, that indicates that a client will not be able to repay their loans when they fall due, and the risk that a client will breach a debt covenant, as many covenants restrict the raising of additional debt. Times interest earned, which is PBIT and interest expenses divided by interest expenses. This ratio measures the ability of earnings to cover interest payments. A low ratio indicates that a client may have difficulty meeting its interest payments to lenders if there is a lack of evidence that the client has the capacity to service its debts. An auditor considers how this ratio has changed over time. A declining trend is a concern, as it indicates that lenders may charge the client a higher rate of interest and future borrowings. In extreme circumstances, lenders may recall monies lent if the client does not meet interest payments. So now is the interpretation of the results of ratio analysis. In general, firstly, the ratios are calculated and then the auditor compares the results with previous year budget and competitors. If there is a significant variation, then auditor discusses variation with the management and tries to find out the reason behind the significant variation, and also considers the effect of this variation on future viability of the company, or is there any going concern risk. And where results are unusual or unexpected, the auditor further investigates, because this indicate risk of material misstatement. Nowadays, more sophisticated analytical procedures are used by some auditors. Audit data analytics is use of software to conduct detailed analysis of client data, such as information contained in the client's ledgers and journals. These applications can be used to conduct analysis, which we just looked at on previous slides. And to conduct multi-dimensional analysis, journal entry summaries, validation reports, criteria generated reports, time series analysis, and regression analysis. Multi-dimensional analysis involve sorting client data into various dimensions. For example, client data can be sorted across dimensions such as location, cost center, or manager. It can then be measured as inventories purchased, inventories sold, inventories on hand, sales, or rent expense across those dimensions. Once measured, data are sorted by dimensions, then can be analyzed to determine whether the relationship between the various data are consistent with the auditor's understanding of their client. Journal entry summaries provide condensed overview of transactions. Summaries can be prepared using a range of criteria. For example, summaries can be made by month, by division, or by manager. Validation reports can be used to report on the report on the validity of the client's data. For example, a validation report can include details of character checks where fields are searched to ensure they include only appropriate data. For example, a numeric field included only numbers. Checks for missing data, checks for data that are less or greater than a certain amount, checks for negative amount or balances, checks that customer numbers are valid, and checks that inventories numbers are valid. Criteria generated reports are summaries of information and data based on conditions set by the auditor. These reports are used to help auditor manage the significant amounts of information and data held in client computer files. By setting conditions or criteria, the auditor is able to collect data that are most at risk of material misstatement. Time series analysis can be used to analyze data that occur regularly within the client. For example, sales made in the past can be used to predict sales in the period under audit. Significant fluctuations are investigated by the auditor. When assessing variations, the auditor will incorporate their understanding of changes that have occurred in the current year that may explain the variations observed. For example, the client may have closed a number of outlets, which would explain a sharp decline in sales. When conducting a time series analysis, the auditor can look at the long-term trend, seasonal variation. For example, sales of ice cream are likely to be higher in summer. Regression analysis can be used to investigate the relationship between different groups of data or variables. This involves consideration of the relationship between a dependent variable, such as sales, and various independent variables, such as selling costs, purchases, and advertising expenses. Regression analysis provides a statistical measure of the association between data. It establishes whether movement in the independent variables results in a change in the dependent variable. We will look at the factors an auditor should consider before conducting analytical procedures. The first is the reliability of client data. If the auditor believes that there is a significant risk that the client's records are unreliable due to, for example, poor internal controls, then they are less likely to rely on analytical procedures. The second factor is whether client data has been audited. If past results are not audited, they are considered less reliable for comparisons purposes. Another issue is the ability to make comparison over time. If the client has changed accounting methods, this will reduce the comparability of the underlying data. If auditors want to make any comparisons, firstly, the auditor has to restate prior year's financial report data using the current accounting methods. During the risk assessment phase, an auditor may only have access to their client's half-yearly results. In this case, firstly, auditor has to annualize the revenue and expenses items before making comparisons with the prior year. The auditor also considers the reliability of the budget before comparing actual financial results to budgeted results. This is normally done by comparing budgets to actual results for prior years. If the client continually overestimates earnings, an auditor can take this into account when comparing actual and budgeted results for the current period. Next is comparison with industry data. When auditor compares with the industry data, care must be taken. If the client is significantly smaller or larger than most companies in its industry, comparison may not be valid. Furthermore, if the competitors do not use the same accounting methods, for the comparison is problematic. After conducting analytical procedures, the auditor will investigate every significant unexpected fluctuation revealed, and then this includes fluctuations and where none were expected. For example, a significant increase in sales for no apparent reason, and no fluctuation where there were expected. When they were expected, for example, no significant change in inventories turnover when the auditor is aware that sales have fallen significantly. That's the end of this lesson. In the next video, we'll talk about audit assertions.